All right, Kev. Time to move on to what we thought was something important to talk about, and you wanted to talk about Beyond Meat and the options chain, which I'm finding fascinating. Let's get right into it.
Well, a lot of people have been kind of highlighting the fact that there's a huge borrow cost on Beyond Meat, and obviously, if you don't know, Beyond Meat is the guinea or the kind of poster child of this bull market rally. What started out as a $40 stock when it came out as an IPO has quickly zoomed up to $232. It's been just insane. I think it has a bigger market cap now than all of Molson or whoever owns Molson. I can't remember. It's the big brewery and stuff. And it's just been insane. Like the market cap of this thing has gone nuts. And one of the things that's happened is people that have been trying to short this thing have had their face ripped off, like just ripped off. And not only are you getting your face ripped off with the reality that this thing's doubling every single week, the other problem is that there's a borrow, and there is a monster borrow, and it's
Monster
roughly
borrow.
when we pull it up on IB right now, they're showing what 130%.
Yeah, it was at one point 136. I think even at one point it was like 144% or something. It's like it's fluctuating, but it's right up there. It's crazy.
So what that means is that if you're short the stock, you're actually going to be paying that amount out over the course of a year. That's an annualized figure. So you basically have to, if you're trying to short that, you need it to go down faster than that rate. And that's pretty hard, right? So it ends up being that it ends up being very difficult to be short this stock. Your timing has to be perfect. But one of the things that people say is, well, maybe I can go trade the options. And so I thought I'd pull it up here, and we're going to talk a little bit about put-call parity and what happens when we get a situation where you get a stock that has this high of a borrow.
Yeah.
Yeah. So if we go pull up like the S&P, that we do the spiders are right now around 301.67. Let's call it 301.70. If you do a September option, and we're going to just choose September kind of arbitrarily, but that's 56 days until September 19th or September 20th of 2019. If you go look at the calls, they're a buck and a half in the money, and the calls for the S&P, these $300 calls would be trading around 690. And then the put would be trading around 470. That seems kind of fair. And, you think about it, the calls are $1.50 in the money. They should be more. Yeah. And it seems like that makes sense.
A slight probability adjustment as well.
Well, no, there's no...
because the one is actually... Anyway, don't worry.
Yeah.
Let's
so it's not... you should be able to go and buy buy the put... buy the call, short the stock, and buy the put, and those three positions should equal each other, and you should be flat. So that's basically
less interest, right?
Right, and that's the key, is it's less interest. Now, when you go look at the options for Beyond Meat, and we're going to pull up something that's the same one, the September of 2019, so 56 days from now. If we go see the stock is trading, when we did this, it was trading around $237. And we see that the 235 calls, which were basically $2 in the money, were trading for around $25. Okay. Then we look at the 235 puts, which are out of the money by $2, and they're basically $53.
Yeah.
And you might think, well,
that's only 56 days. That's
right. And you might think to yourself that this is a situation where this is the market trying to think that everybody is bearish, and that is why the put is so expensive versus the call. But if you think about it logically, you can create a synthetic put by going out and buying a call and shorting stock, which is why put-call parity exists. So when you pull up the option chain, let's go to the next page here, Patrick, and you go look at your Bloomberg or whatever charting package you're using, or not charting, option pricing package, you'll notice that the bid offers on the implied volatilities are actually the same, even though the one is $30 more.
Mm-hmm.
And it's because implicit in there is the cost of that borrow.
Yeah.
So when we go look at the 235s, you'll see that they're showing on this at this particular point. It was 21.20 bid at 24.5 offered. That showed a 95 vol bid at a 105 vol offer. Then we go over and we look at the 235 put, and we see that it is $55 bid and 57.5 offered, and you'll see that it's roughly the same. It's 105 all bid at 115. Now, every kind of person or every entity has a different cost to borrow, and different people have different abilities to borrow that stock. So this is where arbitrage comes into account.
Right.
Because if you can get a better a better rate to borrow that stock at, you can go and lock in a profit by whatever the implicit kind of borrow fee is on the options by creating a synthetic long.
Right.
Do you see what I'm saying? And
yeah,
so
absolutely.
One of these things is that you have to be aware that it's not the market thinking that they're more bearish on Beyond Meat. Because if we remember back, this is an important part, you can make a synthetic put by being long the call and short the stock. Yeah. There is no different. Like if you're sitting there and you're a market maker, or a professional trader, and you have access to a borrow, then it doesn't matter if you have that kind of long call short stock position or you're just long the put.
Exactly. And what's interesting is that this actually creates some interesting opportunities. And one of the things that I like, let's build a scenario, because obviously if you don't view this scenario, then it's not a good trade. But let's say one was saying, look, this thing is just in parabolic mode. And like going back to that chart, let's say you had the hypothetical view that Beyond Meat during this parabolic phase can blow to 300 or even higher, and just can keep going. Because I mean, anything that can go from $60 to $240 in a couple months can go from 240 to 300 just as easily, right? And so somebody that, let's say, wants to get onto this easy money train, at least it always appears that way until you're on the wrong side of the trade, then you want to buy it and participate in the upside. But how do you manage that risk? Well, what's interesting is that right now, like I don't have the quote in front of me, but when we were looking at it, you could right now buy a 235 call option, let's say out till September, for let's say $25. And out to September, you could sell, let's say, $140 put for $25 income because of that carry, not carry, but the interest being put in there for the borrow. And so you actually can be in a scenario where for a zero cost, because the $25 you collect as income at 140 paid for the 235 call. And you basically have all of the upside above 235 for the obligation to own the stock at 140. Now, if you think the risk is that's going back to 80 or 60, well, then the 140 obligation is still a pretty good losing proposition. But if you think that between now and September, the stock can stay above 140 and that this thing could still rip to 300, this makes it a really interesting way at a very low cost to actually keep playing the upside due to that short interest that you're earning on it, right?
Right, so you're trying to find a way to harvest and take advantage of the fact that that short interest is so expensive. And so you're doing it by kind of, let's say, I'm going to buy a call and I'm going to sell a put to finance it, whereas that would usually be kind of an expensive proposition. Or not expensive, but it wouldn't be such a winning proposition. The fact of the borrow makes that much more interesting, because back to our idea that if you think about it costing 140% or something borrow fee, that means that if it declines, it has to decline faster than that for you to make money.
Yeah.
So think about that. If we're short and so the stock's what, 235? Is that what you said? And we said that it's 140. Is that what the borrow fee is? Let's just say it's 140. That means that every single day, it kind of decays 90 cents in your favor. So that means that in a week's time, if the stock you're short and it hasn't gone down $6.30, you've lost money on that position.
Yeah.
And so this is why these kind of situations where you get a huge borrow fee, and I don't know if I've ever seen one like this. Is getting pretty excessive. This is getting right up there in terms of the biggest ones out there.
Have you? Yeah, like I've never seen this.
I've seen lots in this range. I don't know if I've seen anything in the 200. I can't remember anything with a 200 handle except for little spikes. Yeah. But this is a pretty big stock to be at 140%. This is good. But you just have to remember that there's no free lunch out there. So you think to yourself, there's a huge borrow fee. I'm going to go buy puts. Well, no. that's already in the market.
Yeah. Yeah.
And that's what you need to understand, is that is all gets arbitraged out. There's no free lunch, and that is all getting priced correctly. Just go have a look at put call parity between Beyond Meat and just compare it to something that has an easy borrow like Spies, and you'll instantly see what it means. And for those that are interested in option pricing theory, it's a great example.
Well, thanks for sharing, Kev. I think this is just fascinating. It's certainly something that I'm going to keep an eye on for sure.